So I've got some time with you guys today. So I'm Chris Pike. I'm an environmental scientist. I've been in the green building industry writ large since 2002. I've been in the government. I've worked for large nonprofits. I've worked for USGBC, and now twice for the thing we call GRESB. So if you don't know what GRESB is, you're going to know it by the end of this. But I want to frame that in a broader conversation about green building. And I don't stand still well, so I'm gonna move around a little bit. So the key issue is I'm going to talk to you about 5 lessons that are informing where green building is going today. And I'm going to use green building in the largest sense. So green building as a process, the way we deliver higher value, more resilient built environment. I'm going to talk to you about it as a noun, the thing, the green building thing, and green building as a language we use to communicate all around the world. So we're going to talk about green building in a number of ways. We're going to talk about, so let's start with the basics. It's Earth Day, so let's take, to some degree, a victory lap for ourselves, because we're going to talk about the limits of the current moment, but let's also take credit for the current moment, because it is important to reflect on the fact that green building works. And actually, some of the things we need to do today are a function of the fact that green building has been incredibly successful in moving markets. And I want to break that down into 3 buckets. And so first, I'm going to talk to you about basically the story of 3 market interventions. The granddaddy of them all has been Energy Star and energy efficiency. We're going to then talk about LEED, and then we're going to talk about the thing we call GRESB. So they've been in the field since 1992, since 2000, and 2009 in this order. So first, let's be grateful for Energy Star. There is no country on Earth that has something as cool, as scaled, as useful as Energy Star. And let's be clear, it is operated, owned, and functions because of the US Environmental Protection Agency. So if you needed to know what your government is doing for you, this is one of those things. It is, over its lifetime, it has saved 5 trillion kilowatt hours of energy, 500 billion in energy costs, and 4 billion in greenhouse gases reduced. The bottom line from a market transformation is, the reality is, if you see an Energy Star label, plaque, certificate on the side of a building, it is a quantitatively superior building to others. That means it is more likely to have had major upgrades. It's more likely to have a good envelope or shell. It is more likely to have high performance HVAC and controls. These are the attributes it takes to earn Energy Star. Go team. All right. At the same time, we have LEED. Okay, so LEED came along a little bit later, and a lot of you are in this room because you understand LEED. You might understand BREEAM, you might understand Green Globes, you might understand IREM, depending on how you started this adventure. But this is the thing that is maintained and sponsored by the US Green Building Council. In case you're worried, that is not a branch of the US government. That is an independent 501c3 nonprofit membership organization. The result is 197,000 certified projects in 186 countries. That's a lot of countries. Okay, that's a lot of countries. 205 accredited professionals. That is even just as important. 205,000 people who share a vocabulary. They know what energy and atmosphere is. They know what location and transportation is. They know what water efficiency is. And I see some of you smiling because you do too. So it's a language. And collectively, that has avoided 120 million metric tons of greenhouse gas emissions. And the reality from a business perspective is that we know that LEED buildings are more valuable. The idea, the thing, the revolution, the idea behind LEED was to take the opaque, homogeneous thing we call real estate and believe that that they could carve off a portion of it and say, these are market leaders. And by making that leadership visible, actionable, saleable, they could command higher rents based on better experience, higher sale prices, and drive a virtuous cycle. And by and large, they did. I'm going to talk to you about how that looks in a second. And then there's GRESB. All right, GRESB is the company I work for. It used to be owned by the US Green Building Council. I did that, and then I left, and then I came back, so it's a long story, which requires a beer, maybe for later. But the issue is, GRESB is a Dutch company. What we did was we recognized that institutional investors don't generally invest, well, a lot of the time are not investing in a single building. They are investing indirectly in a company or a fund that on their behalf goes in, develops or owns buildings. There was not, in 2009, an assessment of that company or fund, that portco, that they were actually investing in. That company contained many green buildings. And so GRESB was a response to that need. So now 15 years later, we have supported $7 trillion in gross asset value from institutional investors. I call that big, small numbers. We have 160 institutional investor members. They collectively control $7 trillion in real estate and infrastructure investments. That is divided across an annually assessed universe of 3,000 real estate and infrastructure companies. So what does GRESB do for those investors? The number one thing it does is that entities, companies, funds, joint ventures that participate in this process get better over time. The only thing you need to know about GRESB is it is a way to provide transparency for investment, and the longer you do it, the better managed and more performant your investment is. This is what it was set up to do. So the key thing here is that this good is up. Good is up. You want a higher score in GRESB. And if you have been participating for 10 years, you have an average score of 90 out of 100 possible things you could do. The first year is down there closer to 50. Okay, the longer you participate, the more transparent you are and the more value you have created. We'll talk more about that in a second. Okay, so after our victory lap, let's pause the victory lap and say, okay, no good deed goes unpunished, as they say. And 15, 25, 30 years, in the case of Energy Star, of good deeds definitely has changed the market. Let me show you how I understand that change. Okay, what has Energy Star done? Energy Star, in consort with other efficiency programs, has changed the shape of the market. This is when you're going to realize I'm a scientist and I'm going to show you curves and distributions, because I think about the market in terms of a frequency distribution. Essentially, how much of what kind of things do we have? What has Energy Star done? If you look at one way to gauge what Energy Star has done over the last 30 years is this x-axis down here. This is the source energy use intensity. That is a measure of energy efficiency in buildings. To the left is better. That light colored line, I'm just going to be very clear here. This light colored line is how it was in 1995. And if you fast forward 20 years, this is how the market has shifted this way. So what it has done, it did not. If you think that everybody moved, that's not actually what happened. What happened is you shifted the market. You took this tail and you squished it. Oh, you squished it this way. So you've got more highly efficient buildings and you left behind a tail of laggards down here. So, because it turns out, just what did we learn from that? We learned that when you set a bogey, the market converges on performance that is set by a certain kind of availability of technology. It also turns out that buildings can kind of suck infinitely. So this tail continues to go over here, right? Okay, so you have a compression of the leaders. They're converging on goodness. And you have a stretch. So it didn't shift the market. It stretched it to the left. Okay, good. That's a good thing that happened. Okay, but that's real change. That's what actual change looks like. Whatever you think market transformation looks like, that's market transformation. And that's continued. I literally, on the GRESB side, we have hundreds and hundreds of graphs that look like that. That is like the O-negative graph that we have. Okay, so what else has happened? As I said, no good deed goes unpunished. So we, in the case of LEED, have been very successful in engaging major central business district markets around the world, some more than others. So if you go to Minneapolis, San Francisco, Chicago, Oakland, Portland, DC, Seattle, Charlotte, these are places that have over a third of the market is labeled with LEED today. Okay, that's in some ways awesome. It's a sign of relevance. On the other hand, you've got markets that have kind of been left behind. Phoenix, Richmond, Albany, Riverside, Louisville. Okay, there are places that even there, you're seeing 10% market adoption. One way or the other, we have penetrated a large fraction of the commercially viable real estate stock, according to such liberal weenies as CBRE, right? And so I'm totally kidding. They do some of the very best research in this field. So, okay, so what we see is we have done a lot. And moreover, in so doing, we have shown that we are relevant and desirable. So basically, here's a very recent graph from CBRE. I know it's small, so I'll read it to you. The key thing is the bar on the left. If present, and what they mean is if a green building certification is present, we would consider paying a premium for it. So say 45% of real estate professionals asked by CBRE. That's actually a pretty big number. Basically saying that idea of leadership, 45% of people not just are willing, and the next one, if it is absent, 20% of people think they deserve a discount for buying that property. And if it's absent, the hardcore, 12% of people say they consider walking away. All right, okay. My point to you here is that is, in terms of mind share, that's pretty impressive. Okay, but that's also a change. If you go back 25 years ago, that was nothing, 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 and nothing. Okay, so let me go forward for a second here. So what I'm trying to give you is we are more relevant to the commercial real estate mind share. At the same time, if you look at this GRESB-wise, so rather than talking about individual buildings, now we're talking about companies. And I want to show you another confusing graph, but you'll get the point in a second. So the issue here is that if you go back to 2015, 2020, 2023, and you look at the scores we give for how companies are managing sustainability, back in the day, go back to 2015, basically there was a range of stuff. People did something between like 40% and 100%, and the average was kind of in here. Over the past, since up to 2023, you can see that we have seen this profound change. It's even more profound than it looks. This is hundreds of companies. This is thousands of companies, and they are converging in how they're managed. So we have seen a change in how property companies around the world are managed, and a huge convergence in leadership, policy, practices, and process. That's great. At the same time, if you look at that in terms of performance, we've also seen a shift. This is how much data do they have? How are they improving year over year? How are they doing asset level risk assessments? And what we're seeing is this is what it was 15 years ago. This is what it is today. So we have literally seen the market move in real time. Okay, this is good, but it's also bad. Okay, so collectively, we, Energy Star, LEED, GRESB, and other tools in our collective toolbox have moved the market. The market is more efficient. It is more engaged with what we do. We are increasingly relevant to commercial transactions and investment, and there is simply more leadership in this space than there ever was before, and investors and other stakeholders have more data than they've ever had before. Go team. That is success. Okay. But as we said, but because nothing in life stands still and no good deed goes unpunished, okay, investor expectations have changed. So let's talk about how green building is adapting to change. What does green building need to adapt to? And we're going to focus more narrowly on what institutional investors, and just to be clear, by institutional investors, I don't mean you and me as retail investors, like your 401k, which we're not looking at right now. We're talking about your folks like BlackRock, Blackstone, whether it's JP Morgan Chase, the folks who control that $7 trillion, right? What are they telling us? Okay, so if we go back to 2010, what did these same investors tell us? They wanted a definition for green, a definition for buildings, and a definition for companies. They didn't even care so much what was in the definition. They just wanted a consistent, applicable definition. They also wanted transparency. So they would say, we want transparency before performance. We're not going to judge you on how good you are. Just go out and run the 40 and tell us how fast you are, because we have no idea what to expect from that. And then they also said, when you do this, we want to be able to get your data on energy and emissions, and we want to be able to compare it so that I can compare Hines to Tishman to Kilroy to something else, right? That was a world that didn't exist in 2010. Okay, it does today. So I'm going to give you some insights from a group of people that we manage called the GRESB Foundation. So going forward, I'm going to be giving you whose expectations am I telling you? Expectations from a nonprofit governance group we call the GRESB Foundation. It's 144 volunteers. They represent basically 50-50 institutional investors and large asset managers. So this is something that I manage, and if you want to know more about this group, there's a little QR code. But the key is, this is whose opinion I'm going to give you in a second. So For that group of 144 people who sign up, volunteer, contribute their time, and they invest money or run money on behalf of institutional investors, what are they thinking today? These investors expect green buildings to deliver high performance in operation. They think that's what they're buying. 2, they expect green buildings to be less risky and more resilient. That's what they think they're buying. And 3, they want to be able to play the whole market. They don't want to be able to play just 10% or 15% or 25%. They want tools to do the whole market, and I'm going to show you what that means to them. Okay, what do these changing expectations mean today? So from this group of people, what they mean is that green buildings face high expectations. Pale green buildings are risky. And I'll show you in a second why they are kind of the riskiest form of asset. Value must be maintained over time. It is no longer sufficient for a once and done activity. You can't build a green building, dust your hands off and say you're done. That's not how this works anymore. And engaging with only the green stuff is not enough for what investors are looking for. And so let me give this a little more detail. Let's talk about expectations for development. So when an investor goes out and buys a green building today, and I'm talking about your BlackRock, your Blackstone, your JP Morgan, your KKR, what do they think they are getting into? They are looking for high efficiency, low or no on-site combustion, i.e. zero carbon ready. They want resilience to physical risks. They want effective management of social risks and opportunities. Okay, that's what they think they're buying. Here's that problem of the pale green building as an example. So many of you guys have seen a decarbonization pathway or something like that. So that's the idea that here is a pathway where we are over time, over the life of an asset, we are expecting that asset to save energy and reduce emissions. Okay, so I want to tell you a story of 3 buildings. The old inefficient building, the new pale green building, or the new high performance building. The question is, which is the riskiest building in a world where investors are looking to see that efficiency go down, improve, and emissions go down? It may not be what you think. The issue is that this building right here, the gray bar indicates how much life is left in the systems of that building. When do you have to put more capital in to upgrade that building? If you invested in a brand new, shiny, LEED Platinum, zero net energy, operationally affirmed building, I'm looking at you like NREL Research Support Lab, whatever. Okay, that is awesome on day one, and it's got a 30-year glide path of awesomeness ahead of itself, right? That's great. So it is essentially future-proofed out along that time frame. If you have a crappy building, this one up here, that basically it's got old glazing, old systems, old stuff, blah, 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 but it's cheap, and it's and you know that you're gonna go through a capital cycle 5 years from now. Hey, that's not great. It's not awesome, but it's also not that risky because you know that you're not living with those systems. You have a capital moment coming up. The building that stinks, and I'm looking at you, Starbucks, and others like who do a lot of pale green, you do this. If you build that building that is kind of inefficient, just barely above the line today, but you are gonna live with that building for 20 or 30 years before your next capital cycle, that building is going to be on the wrong side of this line, and you're going to have stranded capital from that pale green asset in a way that you don't hear and you don't hear. That's your risky building, and investors know it. So the least popular building in my world today is the pale green building. And if you want pale green, I'm just going to be blunt. Go to Starbucks, and they have thousands of barely LEED certified buildings. That's pale green. Okay? We don't want that. We don't want that not because of some philosophical thing, but because that's what it is right there. Okay, so that's the thing. Okay, so in operation, what do people like about operational expectations? They think they're buying operational performance, and they believe that operational certifications are more relevant. They believe that they are fast and cheaper to achieve because they're based on measured data. And they also know that they're constrained by data availability. Sometimes I'm looking at you, triple net logistics landlords, that it is hard to get the data you need for an operational cert. Okay, so we as GRESB kind of value that proportionally. So we give the most credit to an operational building certification, and for a new construction certification, you've got to pair it with an operational rating to get the same recognition. So we do that. Okay, that's a thing. So operational certifications, go team. The last one is value over time. We understand that investors think that a design rating has value as an indicator of future performance, okay? So they need to see the intent realized in operation. They also want timely and relevant performance data. If you built your building 5 years ago and you say, this is how much I beat ASHRAE 90.1 by, and, okay, what next? And they also believe that third-party assurance and verification is a thing because kind of they don't trust you. Yeah, okay. So what have we done with this? So what we've done is, sorry, everything got kind of mangled in the translation here, but the idea is that we have put a discount rate on certifications. So certifications lose value over time, and they lose value at different rates. So in GRESB speak, years 0, 1, 2, 3, your interior certification, your existing building certification is maintaining 100% value. But as you get out to years 4, 5, 6, these begin to go down fast, which makes sense because you're like, hey, how useful is energy data from 5 years ago? How useful is your building fit out from 5 years ago? And that declines over time. But a new construction holds that value a little longer because, hey, you put a lot more into it, you get a lot more out of it. But by the time you get 10 or 15 years out, these certifications aren't what they used to be. And that's how it should be. Okay, so that's not coming from a GBC, a Green Building Council, or a standard setter. That's what the investors think they're worth. And they voted on it, and it's institutionalized in our system. So that's an indication. Okay, so those are some of the things that are changing. Let me bring this back to investment strategy, because at the end of the day, we are talking about capital-intensive assets, and we're talking everything in real estate, everything in infra is about turning capital into action. So let's talk about how they're investing and how that's changing. So first, what do we know? Sometimes we have insecurity about what we know in this industry. And let me just kind of take a bite at insecurity for a second. We know that companies that own, operate efficient, resilient, and sustainable real assets are better. They're better. They have lower and more predictable operating costs. They have higher and more predictable revenue. They have higher exit values. We have known this since the early 2010s quantitatively. If you want to go all the way back, this is where I started to get excited about it. But we have shown it time and time again, whether it's in REITs, lower volatility and beta, REITs, return on assets, North American private real estate, fund returns, European private real estate, total returns, Asian private real estate, total returns. So when you see a headline, do sustainable companies outperform? Just put it off to the side and go, sustainable real estate outperforms, because sustainable real estate is better real estate. We have shown it dozens of times before, and we will keep showing it, okay? Okay, so the key issue, this led to basically the classic, what I think of as GRESB classic or green building classic. Institutional investors bought this value proposition and they said, okay, we hear you, we get it, green buildings are better. So what we want to do is buy green, engage annually to make sure you don't screw up, and improve incrementally and then sell green. Okay, this is the thing that got us the last 15 years. So they wanted to know what green was so they could buy it and get those premiums. They wanted to check in on you to make sure you were doing good, and they wanted to exit with that premium that they thought they were paying for. Cool. Okay, so we built tools to do that. So our classic tool, we have scores and rankings. Are you green? We have management strengths and weaknesses to have that conversation so that when I sit down with you, I can have a 30-minute conversation to say, yeah, you're not so good in that, or you're much better in that. Okay, and performance metrics. Okay, this is how we responded to that world. Now, here's the thing. The world's changing in response to our stuff, right? What are investors asking about today? It's not simply buy green, hold green, sell green. Now we're talking more about how do I, as an investor, allocate my capital to create value, mitigate risk, and drive impact. And let me show you how those look different. So I'm going to show you a couple of graphs that look like this one. This is a market map for GRESB. All you have to know right now is that these little dots are companies. These companies collectively hold about 300,000 assets. In GRESB speak, that's about 500,000 buildings. The best companies, the ones that are managed well up here, they perform well here. So this is high performance, well managed up here. These are your classic green investments. These are your, for lack of a better example, Kilroy Realty, one of a pure office, highly sustainable US REIT. It's been that way for a long time. If you're down here, that means you don't have much performance data, you are not improving year over year, and you have limited management. These are folks who you might want to buy in at a brown discount. And as you move across this space, you have the opportunity to create value and reduce risk, okay? So let's talk about what that looks like in practice. So if I'm gonna go green to green, my classic model, right? I am gonna invest in a top scoring company. That means well-managed, highly performant. And by engaging with them year over a 5, 7, 10-year hold period, I'm going to prevent them from going down because going down means I'm losing that green premium, and I'm going to make marginal improvements up to the right because, as I showed you, it's harder and harder and harder to get better up here. So your impact opportunities are low, you're managing a downside risk, and you're trying to buy green and exit slightly greener. Cool. What would you buy? If that was your thesis, you buy these guys. And I keep calling these guys out, but there's zillions of them that are like this. You could buy Prologis, you could buy Boston Properties, you could buy Tishman. These are all things you could buy that would fit a green to green model. Great. What's another alternative? Another alternative is you didn't want to pay an upfront green premium. You thought you could buy into that company and you could transform them to be more green. So GRESB tells us that's possible. The longer you participate, you can start down here at a 50. At a 30, I'll show you the 30 in a second, and you can exit up there. What have you done as you go up? You have added value, you've reduced risk, you have basically improved management, increased data coverage, improved year over year, and you have added value. Hopefully you got that added value on the cheap and you sold it for that notional green premium. Awesome. That's awesome. That's impact. That's actually real estate. Buy low, sell high, right? Okay, what does that look like? So last year, a big asset manager called Macquarie Asset Management, it bought a Midwestern waste management company. They went from an initial GRESB score of a 30, 3 years later to an 80 on the back of Macquarie's engagement support to transform that company over time. That's what's happening out there in the landscape. Okay. Let me show you what that looks like in practice. So if you're looking for leadership, and I know we overuse the big European institutional investors, let's at least get one on this continent. So PSP is a big Canadian pension fund. And so what do? How do they put this kind of thinking into practice? So PSP says, we are committing to using our capital and our influence to support the transition to net zero by 2050. Okay, that's what they say they're doing. And they're part of that GRESB Foundation, that's all awesome. So what do? They have a scheme where they say, we are investing in green assets, currently green, the ones in the upper right. And we are investing in transition assets, the ones we think we can move. And we are not giving up on carbon intensive assets, but we know they're brown. And so they are dividing their portfolio and they are saying, we are tracking in these buckets, we are engaging differently in these buckets, and we are allocating capital to do this. So if you put this back here, this is the PSP world. Green to green, 70 billion. Transition assets, 20 billion. Carbon intensive assets, a bit less than that. So you can map these things on there. This is what we're trying to keep up with. This is what green building needs to keep up with, is helping investors allocate capital strategically to different parts of the market. Okay, so how do we meet this moment? So what I've told you is that the idea, what investors believe about green building is some good stuff They believe that green buildings have green premiums. They believe they're better assets. Now, what they want to do is take that knowledge and turn it into different ways to deploy capital. Okay, so how do we engage with this? One, we have to meet their expectations. Green buildings can't suck. Okay? They cannot suck because it's not just a matter of how good they are. People already think they're good. So it's not just like you're not trying to convince them they're good. They believe they're good, and if we underdeliver, we undermine the entire value proposition we've spent 25 years creating. So pale green buildings, bad. Green building has to meet the industry at the whole market. We can't hide out in the top 5%, top 10%, even top 15%. The investor wants to move assets around the whole market, and we, as an industry, have not been a partner in that particularly. We also want to understand how those movements create value, impact, and reduce risk. That's the language we need to use. So what does that look like? I'll give you three. We understand we are not backing down from the classic capture green premiums, meet high expectations. Who is that? That is these people. Invest in green, sustain green, sell green. Okay, that's these people. But the reason I put it up here is this is a tough spot to stay in. This isn't easy. This is a competitive, narrow slice of the market where you got to have your stuff together to stay in that market. Okay, the next one is you want to avoid brown discounts, right? So you understand that if you are down here, you have limited management, poor data, poor performance. These are risky. And they're risky in one of two ways. They're either risky in the sense you want to avoid them, you want to sell them, you don't want to own them, or better yet, you want to transform them. So important thing is to know if you're down there. And if you're down there, the part we need to do more of is this right here. You know you're down there, and you have a way to create value, reduce risk, and bring yourself closer to this. This is what we need orders of magnitude more of. And we need to deploy more capital and create more tools to do this. Okay. So that's what I had for you. What I hope you took away from this is green building has been incredibly impactful. Our own success has changed the market. Those changes have created new expectations for investors and new value opportunities, new propositions that we need to step up to. We need to recognize that we have created high expectations. We have to live them. We have to realize we left part of the market behind while we did this, and investors want to go get it. Let's help them make a positive impact and create business value as we do it. If you want to learn more about how we talk about this stuff, including a deeper dive treatment on why this brown to green thing is so important, there's a podcast for that. If you don't know anything about GRESB, there's an AP for that. And if you just are interested in whatever I'm babbling about, there's something for that. All right, that's what I got. Jonathan, where are we at?
Thank you, Chris. So Chris, I knew you were going to bring energy for us. I know that about you. And that's one of the things I really love about you and why I really wanted you here to speak with us today. So are there any questions? Okay.
Bring it.
Go ahead.
We got you.
Thank you. This is fabulous. We're as real estate investors and developers, totally understand it. Here's my question. A few years ago, we were very concerned about the housing crisis. We built a tiny home manufacturing company as an agile solution. Successful. Now we're going into building tiny home communities. So we are buying up RV parks and renovating them to create sustainable communities with solar grids and all that. So based on what you say, my concern is what I'm seeing is we have so many, this is innovative, what we're doing, and it's not just one building, it's a whole ecosystem. We want to get it right. But you mentioned doing like pale green, like we're not sure of all the solutions that we're choosing, the technologies and the solutions for the buildings and the communities. Is this going to play out? Like, how do we know we're not just doing pale green and we're going to be... Does that make sense?
Yeah, it does.
Thank you.
And that's a great question.
And I love you, and we're going to be in touch with you as well.
I appreciate that. Okay, so when it comes to something like that, the direction I'll take it is saying we also understand that we need more sector-specific tools. So we understand that manufactured housing, in the way that you've described it, is different than kind of this one-size-fits-all thing we've done in the past. So that's one of the things we are looking at is how do we do more segmentation of the market so that we can say, hey, what's going on in manufactured housing of a certain scale? Right now, we're doing that with data centers. We're doing that with logistics. We're doing that with multifamily. And so going to next year, we're interested in which of these experiments help us provide more sector-specific guidance. Because when you put manufactured housing into a bucket with office and traditional multifamily and whatever, you don't know the answer to your question. So my answer to you is we are looking at more sector-specific engagements. And the model for us is data centers, where we said, hey, we actually, for the first time ever, partnered with a group called iMasons and Climate Accord to develop a fit-for-purpose bespoke standard for that because it has different performance metrics. We also think that matters for living spaces but you've got two innovations. You got manufactured housing and you've got living spaces, so you get a different denominator on the bottom. So that's a long answer to, hey, sector-specific indicators and performance metrics that are fit for purpose for that segment. And we're working on that. I'd love to talk about that.
Next question is, I just drew a blank. Sorry. So how do you raise the bar?
Yep.
Right? Because as time moves, you're constantly having to raise the bar.
Yep.
And so we're bringing technology from Australia that's been used all over the world. We could do 4 million square feet in a year of homes.
Yep.
So if you know the numbers like that. And so we're getting to a point where we're dropping the energy usage for a home down to like a fraction of what a standard home uses. So how do we come to you and say, this is what we have, now let's raise the bar to that? Or how does that work?
That's a great question. So two answers. One, you're working with the right people. Like Australia and the Australian market is the pace setter for the GRESB universe. So basically, there's two answers. One, the market tells us where the bar is. And the Australians, for the last 15 years, have set the top right of the benchmark. It is Australian companies and Australian solutions who are literally defining the top of the benchmark, and the rest of the universe is struggling to keep up. And so that is, you're off to the right start. Two, we understand that we are trying to raising the bar at the challenge. That's what that foundation is for. They're telling us we have to change faster, and we have to give the market multi-year trajectories of what improvement is expected from them. Whether that's a energy efficiency pathway, whether that's a decarbonization pathway, or in our case this year, we introduced energy efficiency scoring with ASHRAE 100 as a specific target to try to raise the bar and increase recognition for operationally efficient assets. We're doing the same thing for embodied carbon. We're doing the same thing for water and ultimately waste. And so we could have a larger conversation about that, but the very first thing, you're working with the right people because those are the ones setting the bar. Cool.
All right.
Yeah, I'm wondering if you have any thoughts on the use or the future of green building markets and the integration with Web3 and decentralized systems and fractional ownership.
Interesting.
Yeah.
I'm not sure I have a profound opinion, but maybe I'll kind of bounce on decentralized systems for a second. It's something that I don't think I had the full answer to your question, but I will talk about decentralized for a second. I showed you a couple of graphics that show energy use intensity decreasing. And you guys also know that at the same time, there is a limit, and we probably already reached it in many markets, where simply decreasing energy efficiency, improving energy efficiency as reducing EUI has a limit. And what the grid really needs from us is distributed resources that are dynamic and interactive so that they are aware of pricing and and that those individual buildings understand the needs of the grid and can meet it. We're seeing that when it comes to energy consumption. We're seeing it when it comes to energy production. So whether we are looking at the value of rooftop produced energy or the value of saving energy, the shift we're going to have to make is from annual averages of saying, hey, on average for the year you were good, to were you dynamic and responsive to your site-specific, time-dependent needs of the grid. That's a big lift. But if you look at the last 3 years all around the world, whether you were in the Netherlands, whether you're in California, whether you're in Texas, whether you're in Australia, the number of hours per year that the grid is basically giving away energy, curtailment rates, have gone from essentially 0 to 10% in the Netherlands, 25% in Australia, north of 25% in California. When I hear that issue of distributed engagement, site-specific interactivity, that future is coming really fast. Like, and if you're a nerd like me, that's like, if you check out like gridstatus.io, you get that daily sense of how the world is changing on that. So it's high velocity. Probably worth a side conversation about the rest of it. I'm not sure. But so distributed dynamic stuff is next.
Hi, excellent presentation, thank you. So, given the nature of education, I know you're with William and Mary.
Back a long time ago, yeah, Georgetown today.
So, what is the foundation doing to penetrate the dual kinds of programs that deal with real estate? I'm in a college of architecture, and we have land and property development. But then you have the business school, and they have the real estate. So, is the foundation doing anything to reach the next generation of students that are going to be the professionals in the industry?
That's a great question. So that traditionally hasn't been where the GRESB Foundation has been, although it clearly should be. And so maybe I'll put my USGBC hat on. I think this is where, maybe to generalize the point you're making is saying, we understand there's multiple educational streams out there. I teach urban planning. We have our colleagues in architecture, we have our colleagues in business, and these are like cogs in a machine that are running at different rates with different concepts. And so I think that there's a huge opportunity for better integration, and I don't think any of us have adequately helped those folks in the academic realm connect to the front lines of practice. I mean, we have great examples, like when we've done things like introducing lead O&M in lead lab to different folks. That is awesome. That gives hands-on experience, but it doesn't address the kind of bigger picture things that and I recognize that from my work at Georgetown University today. I teach planning. I know socially my colleagues in the business school, and I know we don't have an architecture school. So we have these disconnects that you're talking about. And so I more can honor that they exist and that they're meaningful and that they should be addressed. I don't have any magic solution right now, and maybe it's worth a side conversation about. It's an opportunity. So I can definitely affirm it's a significant opportunity.
Thank you. Thank you for the very informative presentation, your wealth of knowledge, without a doubt. So I recently went to Los Angeles for the Climate Week there, and I attended a panel on climate disasters and insurance, and basically how insurance companies are fleeing California, Florida, Texas is kind of on the way too.
Yeah, headline this morning.
Yeah. So I think you probably know where my question's going. It's basically how green buildings and insurance companies are shaking hands and where the future of that may go.
All right, I definitely have opinions about this. All right, I'm glad you were there. That was an important event. Okay, so let me step back. That's actually where I started. I started in adaptation and impacts 20 years ago. Okay, let me break it down into 3 succinct answers. One, there's always been this idea that insurance companies were kind of going to be our friend, our buddy, in this adaptation thing, and that basically they were going to that if we did the right things, they would offer us discounts, and there would be this synergy between green building and discounts. Okay, that's not the world. That's never been the world. That's not the world. So, on the other hand, what we've seen is that insurers, they want to run away because they want to take risk off their books. Their goal, they didn't exist to give green buildings nice little discounts. They gave to get rid of risk on their books, and giving nice little discounts for small practices was not going to get them there. Okay, so the other problem green building has in this space is we're not as resilient as we say we are. And people think, if I think there's the biggest liability that green building have, is that people think that green buildings are resilient buildings. but if you're in this room, you probably know that's not the case, right? They can be resilient. There are ways to build resilient green buildings, but every green building is not resilient. So, and even if you look, God bless LEED v5 for its new, basically, site resilience assessment sort of thing, but talk about 10 years late on that, right? And talk about not barely meeting the moment, right? So the key is saying we have to get our own house in order when it comes to that. The other piece of resilience is, the way I think about the market is, the top green buildings have to be more resilient. They have to catch up with what people think they are, and they got to do it quick. And the real risk in the market is in that lagging tail that we don't engage well anyway. So that's when when we go to the insurance company and say, hey, engage with us, they're looking at the long tail of risk out the left side, which is the side we don't do well. So we really need to do a gut check when it comes to that. We need to make sure that our own product as an industry is, as a matter of course, more resilient. And we got to find new ways to engage with where the risk actually is, which is not the people we traditionally work with. And anyway, we could have a great conversation about this, but this is, it's a huge opportunity and a real weakness for what green building is today. We could talk more about that. Great question, and that the LA part is a huge epicenter of that. We're working on that topic.
So we'll do one more question, then we'll go to a break. So let me bring.
I forgot to say ours are indestructible.
Okay,
That was a big word I missed.
that's okay. So
Literally indestructible. We are going after those zones because $45 billion
Yeah.
in insurance, our losses, they're only throwing $1 billion and leaving.
that would meet the expectation.
We're doing that.
Indestructible meets the expectation. Yeah.
Awesome. So as you mentioned, green doesn't mean necessarily it's resilient buildings, but also accessibility, and that's part of resiliency, but even more than that. And I've had a lot of different conversations on, as we create more real estate and sustainable real estate, are we thinking about how people can age in their homes? And accessibility is a big part of.
Yep.
And it's not a topic I hear that much, so I want to hear more about how can we get that topic to be at the center of the conversation when we're talking about green and sustainable solutions.
That is I'm glad you brought that up. It's a great topic. I wish I could do more than affirm the observation, because what I can do is affirm the observation. I don't think we have talked enough about different segmented groups. A little bit of a bright spot in that. I think that from the LEED perspective, from the enterprise green communities perspective, we have started institutionalizing things like health action plans. The reason health action plans matter in this way is that what those plans are doing is they're asking for community needs assessment first. So they're trying to say, don't think about health generically. Think about the needs of specific populations, and then reflect those population needs in your design and your allocation in the project. I have hope for that, because I think when you start from community needs, you start in a more expansive view. I know from having worked on that is not fast enough. It's not big enough. So I want to give enterprise a call out for really institutionalizing that. I'll give LEED a call out for giving us the tools, but not the kicker. I do think for an aging population with those kind of needs, this should be more prominent than it is. Probably in equal measure with kids and those kind of things. So we are centered in the middle. So I'll just say, honoring your observation, definitely true. Are there some bright spots about how we're thinking about population needs? Yes. Are those the exception? Yeah. Do we need to do more? Yeah. One last thing on that. I will just say, we actually see more hope in some ways in infrastructure investors who are investing in social housing and other things at different scales. They don't call it real estate, but they're way more open to that. So I know it's a little weird if you haven't thought about what is infrastructure. That's opens up a little can of worms, but we see actually a lot of progress on the infra side of that. Worth a different conversation.